Interest rate risk management, IRRM, is a fundamental component of financial risk management, FRM, because fluctuations in interest rates directly affect an organization's financing costs, investment returns, cash flows, profitability, and enterprise value. Changes in market interest rates influence both assets and liabilities, creating uncertainty that may significantly impact financial performance and strategic objectives. Consequently, Treasury management seeks to identify, measure, and manage interest rate exposures through an integrated framework that combines policy development, quantitative analysis, derivative instruments, governance, and accounting controls. The CPA Australia Financial Risk Management Framework adopts a structured 5-step process for interest rate risk management that enables organizations to align Treasury activities with corporate strategy, maintain financial stability, and preserve shareholder value under changing economic conditions. Step 1. Set the core criteria. The first stage of effective interest rate risk management is establishing the core criteria that guide Treasury decision-making. These criteria are determined by the organization's overall financial strategy, risk appetite, capital structure objectives, and funding requirements. Senior management and the board define acceptable levels of interest rate exposure by considering earnings volatility, cash flow stability, liquidity requirements, debt capacity, and long-term investment objectives. Treasury policies establish governance structures, delegated authorities, reporting responsibilities, and performance benchmarks that ensure interest rate management activities remain consistent with organizational objectives. Clearly defined policy frameworks prevent speculative behavior and ensure that derivative transactions and financing decisions are undertaken solely for risk management purposes. The establishment of risk limits and governance procedures also strengthens accountability and regulatory compliance while supporting effective Treasury oversight. Step 2. Identify exposures and sensitivities. Once policy objectives have been established, organizations must identify the specific interest rate exposures affecting their operations and financial position. Interest rate exposure arises whenever future cash flows depend upon variable market interest rates or refinancing conditions. Exposure identification includes analyzing debt portfolios, investment assets, lease obligations, floating rate borrowings, fixed rate liabilities, future financing requirements, and interest-sensitive operating cash flows. Both on-balance sheet and off-balance sheet exposures should be evaluated to ensure comprehensive risk assessment. Sensitivities. Interest rate sensitivity analysis measures how changes in market interest rates influence organizational earnings, cash flows, balance sheet values, and investment performance. Treasury managers estimate the financial impact of parallel interest rate shifts, yield curve changes, and alternative interest rate scenarios using quantitative financial models. Sensitivity analysis enables management to identify the areas most vulnerable to interest rate movements and supports the development of appropriate hedging strategies that reduce financial uncertainty. Management of timing mismatches. Many organizations experience timing mismatches between interest-sensitive assets and liabilities because cash inflows and outflows reprice or mature at different times. For example, short-term variable rate borrowings may finance long-term fixed-rate investments, exposing the organization to refinancing risk and interest rate volatility. Treasury management seeks to minimize these mismatches by aligning the maturity profiles of assets and liabilities or by using derivative instruments that adjust interest rate characteristics without altering underlying financing arrangements. Risk management through offsets. Natural offsets provide an efficient method of reducing interest rate exposure by matching assets and liabilities that respond similarly to interest rate changes. For example, floating rate investments may offset floating rate debt obligations, reducing net exposure without requiring derivative contracts. Where natural offsets are insufficient, Treasury managers supplement risk management through financial hedging instruments designed to achieve similar economic outcomes. Step 3. Appraise risks and set strategies. Following exposure identification, management evaluates the magnitude of interest rate risk and determines appropriate risk management strategies consistent with organizational objectives and risk appetite. Risk appraisal incorporates sensitivity analysis, scenario analysis, stress testing, earnings at risk, EAR, and value at risk, VAR, techniques to estimate potential financial impacts under alternative market conditions. Debt and investments. Interest rate risk management must consider both debt portfolios and investment portfolios, as interest rate changes simultaneously affect borrowing costs and investment returns. Treasury managers evaluate debt maturity profiles, refinancing schedules, investment durations, and interest rate characteristics to optimize the organization's overall financial position. Integrated management of liabilities and financial assets strengthens balance sheet resilience while reducing unnecessary financial volatility. Time frame for interest rate risk management. Interest rate management strategies vary according to planning horizons. Short-term treasury management focuses on immediate liquidity requirements and refinancing needs, while long-term strategies address capital structure, investment funding, and strategic financing objectives extending over multiple years. The chosen time frame influences instrument selection, hedge duration, and portfolio management decisions. Determination of the fixed/floating ratio. A critical strategic decision involves determining the appropriate fixed rate versus floating rate debt ratio. Fixed rate borrowing provides certainty regarding future interest costs but may prove expensive if market rates decline. Floating rate debt offers flexibility and potential cost savings during declining interest rate environments but increases earnings volatility if interest rates rise. The optimal mix depends upon market expectations, cash flow stability, refinancing capacity, and organizational risk tolerance. Revision of hedge policy. Treasury policies should be reviewed regularly to ensure that hedge strategies remain appropriate under changing market conditions, financing requirements, regulatory developments, and organizational objectives. Periodic policy revision supports continuous improvement and strategic adaptability. Step 4. Manage risks through Treasury operations. Treasury operations implement approved interest rate management strategies through day-to-day financial transactions and ongoing portfolio monitoring. Interest rate risk management instruments. A range of financial instruments is available for managing interest rate exposure, including fixed-rate borrowing, floating-rate borrowing, forward rate agreements, futures contracts, swaps, options, and structured financing arrangements. Instrument selection depends upon organizational objectives, market conditions, transaction costs, and hedge effectiveness. Swaps and options. Interest rate swaps are among the most widely used Treasury instruments because they enable organizations to exchange fixed-rate obligations for floating-rate obligations, or vice versa, without refinancing underlying debt. Swaps provide flexibility in adjusting interest rate exposure while maintaining existing financing structures. Interest rate options, including caps, floors, and collars, provide protection against adverse interest rate movements while preserving opportunities to benefit from favorable market conditions. Unlike swaps, options establish maximum borrowing costs without eliminating potential gains from declining interest rates, although option premiums increase overall financing costs. Step 5. Accounting and controls. The final stage of interest rate risk management involves ensuring appropriate accounting treatment, internal controls, and governance oversight. Treasury activities should comply with applicable financial reporting standards, including hedge accounting requirements, fair value measurement principles, and disclosure obligations. Robust internal controls include segregation of duties, transaction authorization procedures, independent valuation, exposure monitoring, limit reporting, internal audit review, and board oversight. Regular performance measurement and hedge effectiveness testing ensure that Treasury strategies continue to support organizational objectives while maintaining transparency and regulatory compliance. Overall, the structured 5-step interest rate risk management process enables organizations to identify financial exposures, evaluate risk systematically, implement appropriate hedging strategies, and maintain effective governance over Treasury operations. Through disciplined interest rate management, organizations can reduce earnings volatility, optimize financing costs, preserve liquidity, and enhance long-term shareholder value in increasingly dynamic financial markets.